Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Cawdery and I'm delighted to be joined by Rick Redding this morning. Rick is a returning guest on our show and it's great to have you back, Rick. Thank you for returning.
Thanks, Simon. It's great to be here and great to be on Radio Cayman again.
Well, your first experience was in 2023. Over a year ago. We clearly made it insufficiently unpleasant for you, so today we will try harder to scare you from ever returning back to the show. Now, Rick, just for our listeners' memory, Rick has a wealth of background in the financial services industry, having worked as Managing Director for products and services at the Chicago Mercantile Exchange, and is the current CEO of the Index Industry Association, a not-for-profit organisation serving the global community of index providers. I've finished and I can take a breath now. Rick, you do insist that I say that what you're about to say, because you might be a little controversial, you might be a little bit off script, shall we say, are your own words and not those of your employer. You don't want to be sued by your employer at this particular moment in time.
Not this particular moment.
Okay, maybe next week, but not today. So, Rick, thank you for rejoining us. Well, the world is nothing if not slightly turbulent. When we read a paper, watch a TV show, listen to a radio show, you can't help but think, golly, it's not a great time to be around, is it? There's always something strange and weird going on, and politics is sort of at the heart of it. We've got the US election coming. We've just had a UK election. We've just had the French election. Oh, there's many other countries that are having elections. Goodness me, even Cayman next year. And I want to start off this show by saying, we all pay incredible attention to politics and we all give politics a huge amount of airtime, a huge amount of coverage. But as an investor, is it really important?
Great question, and I can answer this on a couple different levels. We do an annual survey at IIA of asset managers globally across Europe and the US, and that's one of the questions we ask them. And in general, that gets rated fairly low on what's important. Now, what I do think is important is not necessarily the party, but the politics behind the scenes, meaning what does the membership of whether it's Parliament or the Congress look like? Because I think people give way too much credit on the economy to the head political figures, and it really is more the regulations they put in place. And in particular in the U.S., it really, I think most people like divided government, so the politicians can't do a whole lot. Because
then they can't do things. They can't enact policies, whether those be good or bad. Status quo or continuity is often investors' best friend, I suppose.
Yes. Like I say, really where they have influence is on regulation. Mm-hmm. And the other place where I think is becoming more and more in the news is geopolitics.
But how important, though, do investors care about geopolitics? Because there's a war going on between Ukraine and Russia. There are battles going on in dozens of other places in the world. And there's tension amongst the US, China, Europe, China. So geopolitics seems to be somewhat, I don't know, shall we say, if you're juggling a few balls, there's more than two in the air at the moment. So, and yet markets, last week aside, but markets have been on a, shall we say, a tear.
No, markets have generally disregarded all the geopolitical issues. Where I think it'll be interesting is more on the commodity markets than necessarily the equity markets. Think about if you do have escalation in the Middle East, what that will do to the oil markets. Well, likewise, you're starting to see in the Ukraine-Russia war more and more oil facilities being hit.
Do you think, I guess one casts one's mind back, but casts one's mind through the history books back to the 70s and the oil crisis and the inflationary pressures. Do you think that part of the reason that geopolitics or those sorts of factors have less importance is because, frankly, policymakers, and by that I mean independent policymakers, not politicians, but central banks, have actually learned from history so they don't repeat the mistakes they made. So we had the COVID-related inflationary spike, but that didn't cause a massive economic-wide slowdown as a supply-side shock would have done in the 70s, or did in the 70s, because policymakers said, well, we'll have to accommodate this, as opposed to we need to immediately restrict it.
Well, that's the key point right there in what you asked, is does it affect the economy? Yeah. What we see a lot now in geopolitical events is it causes volatility. It's not prolonged. So if you did have prolonged inactivity, which we did in the 70s with the oil crisis, that actually does impact the real economy. A lot of what we've seen in the last week, in my opinion, is volatility. The question is the underlying root cause of the U.S. market going to impact the economy, i.e., what's employment going to look like in the next year? But a lot of the noise we're seeing now, to me, is just volatility.
And I guess if I put myself in the shoe of an investor listening to this and say, okay, if it's actually volatility, then I should, for all intents and purposes, as unpleasant as watching your portfolio go down one day might be, you should ignore it because it's movement around a mean, isn't it, as opposed to a directional change?
One thing that I would encourage anyone, and I think if you work with a financial planner on the island, is have a plan for what you want your finances to do. And you have to stick to that plan because, yes, as you say, it's painful to watch your portfolio go down, but you need to think about what is the goal of your investments. Is it to retire better? Is it to put your children through school? You have to have the proper context on why you're investing. A lot of people's investing philosophy is, oh, crypto's going up tomorrow, I'm buying crypto.
I read an article just perhaps Monday or Tuesday, which was describing the scenario when the market this week had its bad day. And I think Charles Schwab's computer system went down for a lot of retail traders. And the argument was, actually, that probably saved a lot of retail traders a huge amount of money because they couldn't sell on the worst day. The market then bounced a little bit the next day. And at some point, I suppose someone's going to write an economic paper analysing the benefits of computer crashes during market crisis because investors are unable to do what is psychologically ingrained in humans to do, which is to panic.
Yeah. No, I mean, the thing we can't regulate is panic, fear, and greed. At the end of the day, that's the hardest thing. The markets can't regulate that. And really, when you think about even a lot of central bank policy or geopolitics or politics in that matter, a lot of it's psychology. It's how you feel about the market. And it really should be down to how you feel about it, not, as you started this off, listening to the pundits on television or opening the newspaper because, that's all noise mostly.
Yeah. Well, moving aside from noise then, if we can, just to looking about what actually might be going on in the real economy. The US seems to be in the early stages of a slowdown in economic growth, which I suppose in many respects is inevitable. It's had such a long period of sustained economic growth. We've got chatter from certain officials talking about, well, no, the Fed's absolutely not going to do an emergency rate cut, which is a very strange thing for Fed officials to say they're not going to do. The only reason to not do it is because they've discussed doing it, logically. So where do you think we are then in terms of the economic scenario with respect to the employment level in the US and where that might go, and also what the Fed's reaction function to that might be?
I think the Fed needs to take a deep breath and realize what their policy goals should be. Likewise for investors as well. Because I think the real issue in the States is, this whole nonsense about an emergency cut, I think, is for people who's feeling pain in their stock portfolio.
After 2 days.
After 2 days or 3 days. I mean, whatever it is. I think what they really need to think about is their dual mandate. It's employment, but it's also inflation. Because what have we learned from the 70s and 80s experience, and even this experience to a certain extent, is that last mile to get inflation down is the hardest job. And when you see where politics intersects with this, is you're starting to see more and more deglobalization of supply chains and more regional, which probably means there's some inflationary pressures there. So it really does matter how you look at this. And I think the Fed rightly is not going to do an emergency cut. Now, I think I said on the last time I was here, the worst job I think you can have in the world is to be a central banker because it is just such a difficult task. Yeah. And where we are right now is...
And you'll always be criticized because there'll always be at least half the population who think you've done a bad job.
Absolutely. Actually, it's probably more than half because people vote twice. I think what they really need to think about is sending the market the wrong message. Going too fast all of a sudden will say, people will read into that, oh my gosh, the Fed thinks the economy's collapsing. And if you think about the pain over the last few days, this is all based on really one employment report. Mm-hmm. I mean, before the next Fed meeting, there's 2 PPI and 2 CPI reports. So I think they'll get a better handle of where that side of it is. And the other thing is, though, this Fed is particularly influenced by the labor force. Because what people don't realize over the last kind of generation is more and more economists at the Feds are actually labor economists, not macro economists like, back from the 1980s when we had those problems. So they're very focused in on the employment situation.
I will sort of challenge one element of this just for intellectual debate purposes, which is a lot of what the Fed does policy-wise takes a time to action. And so and I agree with you that there's almost certainly no emergency cut, but I could see the value of the Fed being a little bit more aggressive than it might normally be. It might normally be a bit timid, 25 basis points cut, but a 50 basis point cut could have, because the lingering effects of the rise that has happened is still being felt by people as mortgage rates are resetting. So the pain, even of a cut today, would still in aggregate result in increased pain for people because of the after effects of what's happened over the past 18 months.
People forget how fast they raised rates. They did it in 75 basis point implements in a couple of times. So yeah, I don't think the magnitude of the next cut is really the issue. I think it's the direction over the next 6 months on where they want to move rates over that period. I think a lot of people are pundits on TV are, is it going to be 50? Is it going to be 25 in September? I don't think that it matters as much. I think it matters more how they talk about it and how they talk about the economy.
And you don't think the Fed will be swayed one way or other by the fact there's an upcoming election? There's a lot of hyperbole, I would say, about, the Fed doesn't change interest rates during election cycles. Just not true.
Yeah.
Fed absolutely does change. Typically, it doesn't change them because politicians are quite sneaky about making sure fiscal policy creates conditions of optimal scenarios as you approach an election. It's not in the politician's nature to want to have a negative economy at the time of an election. So the Fed doesn't tend to need to, but it absolutely, when it's needed to, has been willing to change interest rates, hasn't it?
Yeah, so if the Fed really wanted to have a big impact on the election, they would have cut rates much earlier in the year because it takes time for those cuts to run through the economy. Now, it does help on short-term things like if you have an adjustable rate mortgage, that does have an impact. But most of the impacts of monetary policy take 9 months to run through the economy.
Although I guess if the Fed were to cut rates, one can imagine the squeals that would come out in terms of, you're influencing by presumably favoring the Democrats because they're in power as opposed to favoring the Republicans who aren't in presidential power, shall we say. So there'd be a lot of squealing that would come out, but the Fed's independent for a reason.
It's back to your point. 50% of the people are going to be upset. Now, I think more than 50, because like I say, even if you're for it, they're going to say this is political. And I think you have to ignore a lot of that noise. Do
you worry about the labor market circumstances in the US at the moment?
I think you're seeing a fundamental shift in the market. I think where they need to be concerned is what types of jobs are leaving the economy. If they're technology jobs, then I think they need to be concerned. Other types of jobs, what's natural unemployment? You have to remember, this freak out in unemployment is only 4.3%. I mean, it's horrible if you're unemployed, but historically, 4.3% is not a critically high number. If the number gets to 6%, then you're going to have a real issue, I think, in the economy.
One number I like to keep my eye on is the underemployment rate.
Yes.
And that's a mouthful to say, isn't it? But that actually is it. So just to sort of explain what that is, that's not those people who are out of work. It's those people who don't have as much work as they would like to have. So maybe only able to get a part-time job, but would want a full-time job. Maybe only able to earn a certain number of hours, etc. And that has come down substantially over the last few years. So there's a lot more settledness in the labour market, albeit that we are hearing signs from some companies in their most recent quarterly results of potential job cuts. But part of that would be companies that ramped up aggressively for speculative reasons and now are having to realise not all paths are paved with gold, shall we say.
Yeah, no, and people have to look back as, the other part of the unemployment picture that people don't pay a lot of attention to is people that are actually seeking work. And this has really changed since COVID. A lot of people just left the job force. So I think you have to look at underemployment, but you also have to look at the labor participation rate. Who's willing to work? And I think
demographics are having an impact on that. The aging population means there will be fewer, apart from the immigration matter, but there will be fewer people able or wanting or capable of working.
Well, and this has long-term impacts on the economy as baby boomers are retiring at $1 million a day or whatever the crazy number is, and someone has to pay for them in their retirement, and that's going to become a bigger and bigger issue over time, because I think one of the biggest issues that people aren't discussing is the amount of debt in the system.
Well, we will discuss that, but we will discuss it after a break. We are right on time, so we will continue our conversation with Rick Redding on this veritable range of current affairs and economics straight after the next break.
Hi, I'm Kathy Miller. Join me on Radio Cayman's Business Buzz every Tuesday and Thursday from 7:30 to 9 a.m. and the second and fourth Thursday of each month from 8:15 to 9 a.m.
Radio Cayman's Business Buzz. If you're a business owner
or part of one, Business Buzz is your source for the latest initiatives, developments, and varied viewpoints from the local business landscape. Be part of the Business Buzz with me, Kathy Miller, every Tuesday and Thursday morning on Radio Cayman.
The Business Buzz.
Radio Cayman, maintaining the innovation.
On a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note.
Message us at 925-3261 on WhatsApp today and get active with Radio Cayman.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense and our conversation on global financial matters with Rick Redding. Rick, we led into the break with a conversation about the employment scenario in the US, and you teased us with your concern, which was debt burdens. So talk to us a little bit, if you wouldn't mind, about why debt is, in your perspective, a concern at the moment in the US and what the factors are affecting it.
So there's two levels to this. One is obviously the government debt has just exploded since COVID. I mean, we're at 36.
But do people care about government debt anymore? No one cares in Japan. No one seems to care. Well, US government debt is now more than I think Italy's was when we had the European financial crisis, and no one was speculating that Italy was the next one to leave the Eurozone.
Yeah, no.
So who cares?
What you have to look at is really the debt to GDP ratio, which is something that scares me in the U.S. because when your debt gets above your GDP, the question is how do you repay this without just totally monetizing it and passing the problem on to your children, and let their inflation, let their lives get, more and more expensive every day. And I don't think people think about it in those terms. But the other thing is personal debt. I saw something a couple of weeks ago that in the U.S. there's $1.1 trillion in credit card debt. And
that's affected by interest rates dramatically.
And 10% of the credit card debt, people are late or delinquent on their payments. That's a real issue.
Is that what it is now? 10%?
10%.
That seems quite high. Is that presumably that's higher than it has been for some time?
For quite some time. And I think it's this cumulative effect of having debt. And, and credit cards with 20+% interest, it's hard for people once they get in that cycle to get out of it. You're also seeing car repossessions go up. And again, this is all back to...
We don't talk about cars on this show. I get angry about the car situation in Cayman. Not because there's too many cars, because no one will sell me a car. But my anger is unabated in this matter. I will continue to express... Sorry, Rick, carry on, please. I'll go into therapy now.
That gets back to the interest rates, though, too, right? At higher rates, it becomes harder to, service that mortgage, the credit cards. It's harder to, pay for your car. So,
there's early signs, I suppose, sorry to interrupt, there's early signs I saw yesterday that some of the international travel is starting to slow down a little bit, which again comes back to international travel is often paid for on credit cards. And so if credit card spending is under pressure, those two things are joined at the hip very much.
Yeah. So, that's a great point. And that raises the question, is the international piece purely from business or is it from for entertainment and pleasure? That will tell you a lot about where businesses think the economy is going versus are people now just stretched so thinly on their credit cards that, that's now something that they have to think about before they do.
Absolutely. And in terms of debt, we can't discuss debt without discussing property markets. I saw, what was it, Monday perhaps, there was an article on Bloomberg, and I want to get the actual quote right, but it said something like the CBOE, so that's the, what's that stand for? That's the Chicago Board of Exchange. Board of Options. Yeah, there we go. So CBOE in Chicago, their ex-HQ, so this is a big, well-known organization, is selling its HQ at a price, marketing it at a price of 50% of the pre-pandemic level. So that's the marketing price. That's not even if they're going to sell it at that price, but that's what they're putting it on the market for. Now, is that a symptom of the debt markets that you talked about, or is that a wider problem facing, and we know there's a problem facing commercial property because people are working from home, working remotely, but or is it both? What is it?
I think the property markets are heavily influenced, or what you see a lot in the news, by New York, San Francisco, and Chicago. What those three markets really suffer from is safety issues. Safety issues are probably the number one reason why they can't get people to return back to work and return back to the office. So there's, as you're saying, there's not near the demand for office space as there was in those markets. Now, we can oversimplify the commercial real estate market and say it's all going down. There's things like industrial or, data centers that, are doing gangbusters. But on the commercial side, Class A is holding up fairly. Class B and Class C, a lot of these places are selling for 50 cents on the dollar. There's buildings in San Francisco that sold for 90% off of where they were pre-pandemic levels.
Do you think there's any spillover either in the works or maybe not at all, but is there a risk of spillover into the residential market because of interest rate costs, because of a slightly demographically changing population? I mean, the US is still going to see an increasing population, which presumably is good for property markets, but a change in demographics will affect what people are actually wanting to buy, and locations as well, right?
Yeah, so a lot of times when rates are high, and I put that high in quotes, is you see people not make that home purchase, but they go to multifamily, they go to apartments or they rent until rates come down, because people always forget you're buying two things when you buy a home. You're buying a place to live and you're also buying a mortgage. And so I think what you've seen is a substitution to multifamily. And you've seen a big difference, and this is where markets that people are moving from to. I mean, you're still seeing markets like Texas and Florida still having pretty good results. Florida less so than Texas, but those are still pretty strong. There's not enough supply in those markets, keeping home prices high.
I was at a conference 3 weeks ago, which was frequented by some people from the property space, and they made almost exactly the same argument, but in a much more bullish way. They were property fund managers, so they're inclined to do that. But their argument was very much that, which is the cycle of interest rates is where we are. Home prices prices have been depressed for some time in the multifamily space particularly, and the demographics in certain markets are incredibly attractive, and the yields that you can get on those as an investor are incredibly attractive. So I think we perhaps risk tarring the whole property sector with the same brush because we see the headlines and we don't look at the nuances in various sectors. And that's a human failing generally, isn't it? You look at a headline and you go, well, it must all be bad, whereas actually that doesn't mean everything in that sector is bad.
Yeah, no, and I think you're seeing a lot of that in the media right now. Is they'll pick up on the one
and gloom.
It sells newspapers, it sells content, it's clickbait, but you have to do a lot more, I think, detailed analysis before people make these huge, claims that the real estate market's dead forever. I think you're in a period of transition. I mean, there'll be at some point likely. People will go back to work. If, people feel safer in those big cities, they'll go back to work. In a lot of the cities where people feel safe, it's 90+% people go back to work.
Fair enough, yes. Now, at the very beginning of this year, I think the first show that we did in the year, I said to one of my guests, I said, interest rates today are 5%. I can earn 5% sitting in a money market fund. Why would I take the risk of investing in these volatile asset classes? Now, the S&P 500, I think, is up about 8% right now, year to date. And if I'd been in a money market fund where I'm in August, I'd be up 3%. So the hypothesis was clearly proven to be wrong by the fact that but if you, how is someone persuaded when they see the opportunity cost of taking risk as being a 5% return? Isn't that quite a difficult thing to motivate people? Because human beings should be taking risk because they need to earn the returns for retirements and for savings. But the 5% number is quite a headline-grabbing one to say, oh, that scares me. To get to 9%, I've got to experience all this scary stuff. How does someone get over that psychologically, I wonder?
Well, I think there's two things going on there. One is a behavioral issue or psychological issue in that we've been anchored at zero rates for 15 years. I mean, and so everyone sees 5% now, and it's like, wow, this is a free gift. This is the way it used to be all through, with the exception of the last 15 years. For the last 40 years, this is, the last 60 years, this is kind of what it looked like.
This is normal, in other words.
Yes. So people are anchored at zero interest. The other thing, in the reason why people need to think about investing in other asset classes is if rates are at 5%, they're at 5% for a reason, because that means underlying inflation is anywhere from 2% to 3% in normal years. So some of that's being eroded, and that's why you have, depending on your age, depending on what your investment philosophy is, if you have to pay for your kids' college, if you want to go to retirement, you have to have assets that will return more than the rate of inflation that will get you to a better economic place so you can retire.
But you have to have a relatively long horizon to do it. You have to be immune, or you have to make yourself as immune, as we said in the first half of the show, to the volatility and the scary stuff that goes on day by day.
And that's hard. I mean, psychologically, that's hard to watch your money that you've invested and put away just go woof.
I remember someone saying to me once that they had an app that they could see their pension on in real time. I said, why the heck would you want that? And they said, well, isn't it nice to know? I said, absolutely not. The last thing you need to know, I mean, you actually need to follow what's going on so the managers are doing a good job. Yeah. But you absolutely, with a pension, which you're not going to be touching for most people, whether it be for 5, 10, 20, 40, the most stupid thing to do is to watch it every day, because you're just going to scare yourself for no beneficial reason.
Yeah. No, and that's absolutely great advice. And I see people look at their pension all the time and say, oh, it's up, it's down. It's like, but if you don't need it for 20 years...
Or you're not allowed to touch it, so what's the point?
Yeah, so you can't get it, unless if you do, you'll take a huge penalty, and it's like, what's the point? So it is just, it boggles my mind that people look at their pension as a trading account.
Or in some respects, their investment account as a trading account. Yeah. People, I think... one of the angsts I have about people in investing is that a lot of people think of investing as trading, as opposed to... don't understand what it is they're doing with investing. And it's not a criticism of people, but it's because of the way that when you watch TV, we make a fast buck here. Yeah. And they assume that's what investing is. That's trading. Investing is putting 5,000 away each year, or whatever your money is each year, for 5 to 10 years, for 20 years. And then you'll be able to afford to retire, or be able to afford the house that you want, or whatever it is. That's investing. That's the other is trading.
Yes. And there are people that do well trading, but it's a handful compared to the people that underperform the market. I mean, even look what Warren Buffett said. Look, if you're not an expert in the markets, you're just better off buying an index fund than doing anything else. So there is something to keep your money in the market. You can't figure out and outtime the market. I mean, it's never successfully been done.
If there were any, and I've forgotten the name of the company, Citadel, I think it is. But if there were any other reason to justify your argument there, it's the fact that when you go to your retail brokerage, Interactive Brokers, Robinhood, or whoever it is, they are paid by market makers to take retail orders, because they know that retail traders are in aggregate terrible. So they want to trade against retail people. They don't want to trade against institutional people, because institutional people do a lot more research and are smarter about how they so they actually pay your broker, they pay Interactive Brokers to take the other side of every trade that you do, knowing that the majority of you will make stupid mistakes.
And I love people's bias about, I can make money trading real quickly because I got a feel for the market. These players in the market now it's all done by computers. Yeah. I mean, these algorithms think in microseconds,
and they are specifically located to reduce the number of microseconds of time it takes.
Absolutely. And so if you think you can outpower a citadel, it's like, good luck to you, but I guarantee you're going to lose.
They are paying to take. It's rather like going to play a game of poker and the other person's around the table paying the house to encourage you to play. They know you're a sucker, right? Otherwise they wouldn't be doing it. They wouldn't be taking the other side of that trade.
And I think there's a historical perspective on this that's important, because in the old days, you used to like go to a pit where somebody on the floor made all that money and probably made a lot more per trade than they do now. So it's always, that slippage has always been in the market. This is just now, I mean, these people are really sophisticated. And look, if anyone out there it knows AI and can apply it to finance, you could get a job at any place you want tomorrow with unbelievable pay.
Look at this. We end our show on career advice. So there you go. That's the most remarkable segue I've seen. Rick, we are out of time. It's always the case on this show that we have too many topics and too little time. So thank you very much for rejoining us. And I do hope you're willing and able to be victimized once again for another show in the near future.
Well, you only invite me when there's turmoil in the markets or in the U.S. So
correlation is not causation, as they say. I don't know where you're going with that. So, as a quick reminder, just to remind our audience, today's show can be found on YouTube. Type Money Sense Cayman, as well as on the CFA Society Cayman Islands website. And very early notice, the CFA Society Annual Investment Forum is on this year. It's going to be at the Indigo Hotel on the 7th of November from 11:30. Type CFA Investment Forum into your browser and you'll get lots of details. Most exciting for me personally, I'm a little bit of a geek, but one of our presenters is going to be talking about planetary exploration and the future of humanity. It's going to be a great, great forum. With all that said, it remains to say thank you to our listeners for tuning in. I encourage you to rejoin us again in 2 weeks' time.